Understanding marginal cost, the key to economic decision making. In economics and business strategy, marginal cost is a fundamental concept that drives decision making at every level. It represents the cost of producing one additional unit of a product or service beyond current production levels. While average cost provides a broad view of production expenses, marginal cost offers precision, revealing exactly how costs change as output expands or contracts. This distinction makes marginal cost analysis essential for businesses seeking to optimize production and maximize profits. Understanding marginal cost allows decision makers to determine ideal production quantities, set competitive prices, and identify when additional production becomes unprofitable. Calculating marginal cost. Identify the formula. Marginal cost equals change in total cost divided by change in quantity, gather cost, data track, total costs at different production levels, calculate the difference, subtract to find changes in expenses and quantity, analyze the result, determine if additional production is worthwhile. Consider a manufacturing example. When production increases from 10 to 11 units, total costs rise from $500 to $550. The marginal cost is therefore $50 for that 11th unit. This calculation captures variable costs like materials and labor, and occasionally includes incremental fixed costs when production expansion requires new equipment or facilities. Real-world examples of marginal cost. Automotive industry. As car factories approach maximum capacity, marginal costs rise dramatically. Additional units require overtime pay, accelerated maintenance schedules, and potentially new production lines. A typical automotive plant sees marginal costs increase by 15 to 30% when operating beyond 90% capacity. Technology sector software companies experience near zero marginal costs after initial development. Distributing an additional copy of a software product costs virtually nothing compared to its development. This creates powerful scalability, explaining why tech companies can grow rapidly once products are built. Agriculture farmers face increasing marginal costs as they add more fertilizer or pesticides to boost yields. Each additional application provides diminishing returns while costs remain constant. Past the optimal point, the cost per additional bushel harvested becomes progressively higher. Importance of marginal cost in business. Profit maximization. Optimal production, where marginal cost equals marginal revenue. Pricing strategy informs minimum price points and discount thresholds. Production planning guides output levels and resource allocation. Competitive analysis reveals cost advantages against market rivals. Marginal cost analysis drives critical business decisions across industries. By understanding where costs begin to escalate, companies can prevent overproduction and resource waste. Airlines use marginal cost concepts to optimize seat pricing, while manufacturers leverage them to determine optimal production runs. In competitive markets, businesses with lower marginal costs gain significant advantages, allowing them to price more aggressively or maintain higher profit margins than competitors. This creates a powerful incentive for operational efficiency and technological innovation aimed at reducing marginal costs.